Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Welcome to the deep dive. Today, we're really trying to crack open something fascinating: the mind of Warren Buffett.
Yeah, but maybe not just the usual stuff.
Exactly. We're not here to just, list his greatest hits or talk about basic accounting ratios. Our mission statement today is pretty ambitious, actually.
It is.
We want to move beyond Buffett's purely mechanical investment methods and really explore let's call it the philosophical, the ethical, maybe even the mathematical architecture that created what people call the money mind.
That phrase itself, money mind,
Yeah.
It's just something deeper, right?
Yeah.
Kind of synthesis that's way beyond just picking stocks.
Right.
And to really get it, you have to understand the journey he took.
Yeah.
Because Buffett's success, well, it wasn't just a straight lineup. It was a huge intellectual evolution.
Okay.
He started out, firmly in what we might call stage one value. That's the strict, very backward-looking accounting rules he got from his mentor, Ben Graham.
The classic stuff.
The classic stuff. But then, necessity and just plain experience forced him to evolve. First, with Charlie Munger stepping in, and then moving fully into stage three value, which is much more forward-looking, business-driven, focused completely on compounding the long-term value of a business.
So it's that shift from buying cheap assets
Cheap stuff.
to buying wonderful businesses, even if they cost a bit more.
Exactly. Wonderful businesses at fair prices. That transition, that's really the key to understanding his long-term success, I think.
And what's so interesting is that phrase money mind. It wasn't some, carefully crafted PR term.
No, not all.
It just popped out, didn't it? Back on May 6, 2017, at the Berkshire Hathaway annual meeting in Omaha.
That's right. He was talking about succession planning, a really critical issue for Berkshire.
Yeah.
And he said the successor's capital allocation abilities were uppermost in the board's mind.
Which makes sense.
Totally. But then, almost as an aside, he just dropped that phrase, a money mind. It really signaled that the board wasn't just looking for, a number cruncher.
No, they needed more.
They were looking for a whole philosophy, a way of thinking.
Okay, so let's dive into how that philosophy, that money mind, actually got built. Let's start right at the beginning.
Well, the ability to think like an owner, like a capital allocator, it showed up incredibly early, way before you ever went to business school or anything.
Yeah, the stories are famous, but they're really important context, aren't they?
They are, because these childhood businesses, they weren't just about making, pocket money. They were like mini experiments in return on investment.
Like the Coca-Cola story at age 6. Buying a six-pack for 25 cents from his grandpa's store.
Right. And then turning around and selling each bottle for a nickel, 5 cents each.
So 30 cents total.
Exactly. It sounds tiny, right?
Yeah.
But think about the math. He makes a 5-cent profit on a 25-cent investment. That's a 20% return. Instantly.
Wow.
It shows this immediate grasp of, arbitrage in pricing. Then, by age 11, he's buying his first shares of stock. He realized he could scale up his capital allocation beyond just selling Cokes.
But the real precursor to Berkshire, maybe, was the pinball machine business when he was 17.
Oh, absolutely. He and a friend buy a used pinball machine for $25.
Okay.
They put it in a local barbershop. They split the profits, just pennies at first. But crucially,
He didn't spend it.
right, they used those profits to buy 2 more machines. That's the micro example of capital allocation right there. Reinvesting for expansion.
And then they sold the whole thing.
A year later, sold the 3-machine business for $1,200, which was a huge capital gain back then. It proved the concept.
So these early ventures, they're already showing that power of reinvestment, of scale. Key traits of the money mind.
Definitely. And this naturally leads into the idea that defines his whole career, compounding.
We usually think of compound interest.
Yeah, but for Buffett, it's much, much broader. The real operational lesson, the deep one, came from a book he found when he was just 11, 1,000 Ways to Make $1,000.
Okay, what was the story?
Well, the book told the story of a guy named Harry Larson. He bought 3 penny weighing scales. And the tiny profits, the pennies he collected, he didn't just pocket them. He immediately used them to buy more scales. Eventually, he had 67 scales.
So using profits to make more profits.
Precisely. establishing this ever-widening circle of returns. That's the core of compounding power for Buffett. It's seeing capital not as a fixed amount you protect, but as this like perpetually breeding resource. You keep redeploying it into things that generate high returns.
But like you said, the money mind isn't just the math, it's character too. And those philosophical anchors were really important. A lot came from his father, Howard Buffett.
A huge influence. Howard Buffett was a congressman, an old right libertarian, very principled. He deeply instilled this idea of honesty, of integrity being paramount.
The famous line.
Yeah, it takes 20 years to build a reputation and 20 minutes to lose it. That kind of ethical grounding, that commitment to being virtuous, it's like the scaffolding for making huge long-term capital decisions. People have to trust you. It prevents those spectacular blow-ups you see elsewhere.
And Howard also introduced him to Ralph Waldo Emerson, didn't he? The idea of self-reliance.
Yes, absolutely. Warren really internalized Emerson's idea of self-reliance, and that becomes the root of his nonconformist, almost contrarian approach to investing.
How so?
Well, Emerson demands that you think for yourself. He wrote, "What I do is all that concerns me, not what the people think."
Okay.
And maybe even more powerfully, Emerson stressed the need to maintain the independence of solitude, to avoid getting swept up in the hubbub of conflicting appearances.
So stay away from the noise.
Exactly. The money mind has to resist mass hysteria, market fads. That ability to just sit quietly, read, think, deliberate, insulated from the daily market chatter that's pure Emersonian discipline and practice.
It makes sense. If you're truly self-reliant, you don't need the crowd telling you you're right if your analysis says you are. But how does that independence of solitude actually protect an investor, practically speaking?
Well, think about it as a psychological shield. It protects against what Charlie Munger later called the social proof tendency.
Which is
the human tendency to just follow the herd, to adopt other people's beliefs without really questioning them. When everyone is shouting that tech stocks are the only future or the market's doomed,
right.
It takes real fortitude to sit back, ignore that noise, and just wait. Wait for the opportunities that actually fit your rational framework. Solitude stops that pressure to conform, which is deadly in value investing.
Okay, so this philosophical base leads him to his first big mentor, Ben Graham. And he really pursued Graham, didn't he?
Oh, relentlessly. Memorized security analysis before he even got to Columbia. He specifically went there to take Graham's seminar in 1951.
And Graham's message was pretty radical for the time.
Totally revolutionary. Wall Street back then was dominated by, tips, momentum, what the crowd thought. Graham just flipped it.
How?
He argued stocks should be valued based on objective financial facts. What the underlying business, the assets, the earnings, what they might actually be worth in a quantifiable way, not just based on short-term market psychology.
And that connects back to Emerson, too, that self-reliance.
It does. Graham himself wrote something very similar. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right.
That must have resonated deeply with the young Buffett.
Absolutely. It gave him the initial intellectual framework and, crucially, the temperament he needed to stand against the market's chaos.
Okay, so when Buffett starts his own investment partnership in 1956, he's basically a pure Graham disciple, right? Practicing what we're calling stage 1 value investing.
Exactly. And you have to remember, this method was forged in the fires of the Great Depression. Investors learned the hard way that, promises about the future didn't mean much if the actual assets vanished. Financial facts were king.
So the core idea was security analysis as, like, a science, focused entirely on quantifiable facts, things you could measure right now.
Precisely. The emphasis was on the here and now, paying low prices relative to current earnings, current dividends, and really importantly, current assets. Often value is almost equated with liquidation value, what you could sell the pieces for.
And the famous golden rules came from this defensive posture.
Absolutely, reflecting that depression mentality. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Simple but powerful.
And the way you achieve that, the mechanism, was through the margin of safety. Graham defined that as the gap, the cushion, between a company's current prospects or assets and the price you paid for the stock, which had to be deeply discounted.
Can you give us an analogy for that? Margin of safety gets quoted a lot, but maybe it's not always fully grasped.
Sure. Graham actually borrowed the term from engineering, specifically bridge building, from before the 1930s.
Okay.
Imagine a bridge is designed technically to hold, say, 10,000 pounds. But the engineers, to be safe, mandate that it should never actually carry more than 5,000 pounds.
Right.
That extra 5,000 pounds of capacity, that's your margin of safety. It's a buffer against bad luck, unexpected stress, maybe a hidden flaw, or just heavier than expected traffic.
So in investing?
In investing, if your conservative analysis shows a company's assets are worth, say, $10 per share if liquidated, but you only pay $5 per share for the stock.
You've got a 50% buffer.
Exactly. You have a 50% margin of safety protecting you if your analysis was a bit off, or if the economy tanks, or if something unexpected happens to the company. It's protection against error and misfortune.
And Graham also gave us the famous Mr. Market parable to deal with the stock market itself.
Yes, the manic depressive business partner. He shows up every day, offering to either buy your share of the business or sell you his share, but his prices are all over the place, driven purely by his wild mood swings.
So how should you react?
With total stoicism. Graham used the term ataraxia, basically meaning tranquility or being unperturbed.
Okay.
His teaching was, if you've done your homework, you understand the real value of the business, and you bought it with a big margin of safety, then you must ignore Mr. Market's daily moods.
So if he's depressed and offering a stupidly low price,
I buy more. If he's euphoric and offering a ridiculously high price,
you sell or just ignore him.
Exactly. But the really hard part, psychologically, is that the entire world, the news, other investors, your gut sometimes is screaming at you to listen to Mr. Market. That's why that Emersonian independence, that temperament, is so critical. Without it, the whole intellectual framework just falls apart under pressure.
Okay, so Graham's framework was genius, and it made Buffett rich quite quickly through his partnership. But then something changed. He hit a wall, didn't he?
He did. A critical, hard lesson that forced him to evolve. Stage 1 worked beautifully when he was essentially trading stocks, buying cheap, holding for maybe a year or two until the price bounced back towards value. But when he started using Berkshire Hathaway as a vehicle to buy and hold entire companies, controlling them completely, the strategy started to show its flaws.
Why? What was different about owning the whole thing?
Because when you own the whole business, day in and day out, you realize that just being quantitatively cheap isn't enough if the underlying business economics are terrible.
These were the cigar butt investments.
That's what Buffett called them, his cigar butt habits. Finding a soggy, discarded cigar butt on the street that has maybe one free puff left in it.
Doesn't sound appealing.
It isn't. You pick it up, you get that one puff, and then you have to throw the disgusting thing away. With businesses, he found buying these cheap, low-quality companies was like that. He called the experience his punishment.
Ouch!
Yeah, he said he got an education in the economics of short-line farm implement manufacturers, referring to Dempster Mill, and third-place department stores, like Hochschild-Kohn, and, of course, New England textile manufacturers, which was Berkshire Hathaway itself originally.
So the painful realization was, what? Buying cheap stocks of fundamentally bad businesses just didn't work if you held them long-term.
Exactly. The initial margin of safety you got on the cheap assets, it just got eaten away over time by terrible profitability, by constant labor issues, by the endless need to pour more capital in just to keep the dying business afloat.
So you save a little up front.
Only to bleed cash operationally year after year. The assets might have looked okay on paper initially, but the actual business was a capital sinkhole. That was the failure insight. And that failure insight, that painful education, paved the way for Charlie Munger. Munger was the real catalyst for the money mind's biggest leap forward.
Buffett's incredibly clear about that, isn't he?
Oh, yeah. He says flat out, it took Charlie Munger to break my cigar butt habits. And then the famous line, forget about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices.
That's the core of stage 2 right there. It sounds simple, but ditching the rules from your revered mentor, Graham, that must have been tough psychologically. What was the biggest hurdle for Buffett there?
I think the hardest part was accepting that paying a higher price to book multiple, or a higher PE, paying a fair price for a really great company, could actually be the safer, more conservative move in the long run.
Because Graham taught cheapness equals safety.
Exactly. Graham's whole system was rooted in avoiding loss by buying at the lowest possible price relative to tangible assets. Munger had to convince him that the certainty of high returns from a great business, the power of future compounding, could more than offset paying a bit more upfront.
So redefining safety from just assets to the quality of the business itself.
Precisely. And Munger brought this whole different perspective. His philosophy centers on acquiring worldly wisdom. He argued that stock picking isn't some isolated skill.
Right. It's part of a bigger picture.
Yeah, it's just a subdivision of a much broader collection of mental models from physics, biology, psychology, history, you name it. You need this lattice work of models in your head.
And a key part of that was studying failure.
Huge part. Munger hammered on the importance of avoiding thinking errors, cognitive biases. This was long before behavioral finance became trendy. He understood that the biggest risk to your wealth isn't necessarily the market, it's the flawed wiring in your own brain.
Can you give an example? How would recognizing one of these Munger-style biases help a traditional value investor?
Okay, think about incentive cause bias. Munger points out that people often do what they're paid to do, sometimes subconsciously twisting their reasoning to fit their incentives.
Like a broker pushing a certain stock.
Or an investment manager who gets paid based on assets under management. They have an incentive to just gather more assets, maybe buy more stocks, even if they aren't great ideas, just to grow their fee base.
Ah, okay.
A traditional Graham investor, just focused on the numbers, the balance sheet, might totally miss that the person selling them the stock or managing their money is operating under this kind of perverse incentive. Munger taught Buffett you have to analyze the psychology of management, of sellers, and most importantly, your own.
And Munger's overall approach to cut through this complexity was pragmatism.
Yeah, that was his core algorithm, you could say, pragmatism. Do what suits your temperament. Do what works and keep doing it. Just be empirical. Look at what actually succeeds in the real world of business, not just what theory says should work. That empiricism helped Buffett break free from Graham's more rigid, asset-focused view.
And the classic case study of this stage 2 shift in action is See's Candies, bought in 1972.
The quintessential example. They paid $25 million, which, by Graham's standards, looked expensive. It was about 4 times book value, a multiple way higher than Graham would have touched based on just the tangible assets.
But Munger saw something else.
He saw a fantastic business with pricing power and customer loyalty, a brand. And the results just blew the old model away.
What were they?
Over the next 42 years, See's generated something like $1.9 billion in pre-tax earnings for Berkshire.
Wow.
And here's the kicker. It only needed about $40 million in additional capital investment over that whole time to do it.
So it just gushed cash.
Like crazy. That's what Buffett meant when he said it was like rabbits breeding, just generating cash that could then be sent back to Omaha for Buffett to reinvest elsewhere.
So what were the big lessons from See's?
Threefold, really. One, See's was actually undervalued if you look at it like a long-term business owner willing to pay for quality. 2, paying a higher multiple is smart if the business is great and can reinvest its earnings profitably or send them back to you. 3, it confirmed the enormous, often hidden value of powerful brands or franchises that let you raise prices year after year. That brand equity wasn't on the balance sheet Graham looked at.
So the focus really shifted to finding these compounding franchises.
Completely. And Buffett loved illustrating the power of compounding with historical analogies, like the Queen Isabella one.
Funding Columbus.
Right. She put up maybe $30,000. Buffett calculated that if that sum had just compounded at a modest 4% a year for the 500 years since,
It would be worth
over $2 trillion today. His advice became brutally simple and powerful. Live a long life and compound money at a high rate.
That became the goal. Okay, so once Buffett fully embraced this idea that the real gold was in finding these wonderful businesses that could compound earnings over time, he needed a new way to value them, didn't he?
Absolutely. The old Graham metrics, focused on current assets and earnings, were backward-looking. They didn't capture the potential of a great business growing far into the future. He needed something forward-looking.
And that led him to John Burr Williams.
Yes, and his somewhat obscure 1938 book, Theory of Investment Value. Williams laid out the mathematical framework that really underpins Stage 3 value investing.
Which is what, basically?
Williams stated very clearly that the value of any asset, whether it's a stock, a bond, a whole business, even a farm, is determined by the cash flows it's expected to generate over its remaining life.
Okay.
Discounted back to the present day at an appropriate interest rate. He called these future cash flows the future coupons of the investment.
So discounted cash flow or DCF analysis?
That's the one. Intellectually, it's the only truly sound way to value a business based on its future prospects.
But it's hard.
It's incredibly hard. Unlike a bond, where the coupons are usually fixed and you know when you'll get them, with a business, you have to estimate those future cash flows. For years, sometimes decades out, you're making assumptions about growth, competition, profit margins, how much capital they'll need.
And that uncertainty is exactly what scared off the old stage one guys, right? They preferred the certainty of tangible asset values right now.
Exactly right. But Buffett adopted a different mentality here, influenced again by pragmatism. He realized that trying to get the forecast precisely right, down to the penny, was often a fool's errand. Intellectual delusion, maybe?
So what was his approach?
He essentially said, we would rather be approximately right than precisely wrong. A rough estimate is good enough if, and this is crucial, if you still demand a significant margin of safety in the price you pay compared to that estimated value.
Still need that buffer.
Always need the buffer. Williams himself warned about this. If you pay more for a stock than its true investment value based on those discounted future cash flows, your only hope for profit is to sell it to someone else willing to pay an even higher price.
Which is speculating, not investing.
Precisely. You're playing the greater fool game.
And this shift in valuation wasn't just theoretical, was it? The whole economy was changing in ways that made the old metrics less useful.
Hugely important point. Starting around the 1980s, the economy fundamentally shifted. Away from heavy industry, tangible assets like factories and machines, towards knowledge work, services, software, brands, intangible assets became much more dominant drivers of value.
And the problem is, those intangibles often don't show up properly on a traditional balance sheet.
Exactly. Things like brand value, patents, software code, network effects. They might be worth billions, but the accounting rules back then just weren't set up to capture them accurately. So metrics like price to book, PB, or even price to earnings, PE, could be dangerously misleading if you didn't understand the underlying business economics.
The classic example of navigating this shift is Coca-Cola in 1988.
Textbook case. Coke looked expensive on the old metrics. High PE, high PB. Stage one investors ran screaming.
But Buffett and Munger saw.
They saw the incredible power of the global brand, the distribution network, massive intangible assets. They saw that the CEO, Roberto Goizueta, had fundamentally improved the business's economics, allowing it to generate fantastic returns on capital.
So they used the Williams framework.
Essentially, yes. They used a version of it, maybe a simplified discounted dividend model in this case, to estimate Coke's intrinsic value. Their math suggested that while the market was pricing the whole company around $15 billion, the actual intrinsic value, based on pretty conservative estimates of future dividend growth, was likely somewhere between, say, $21 billion and maybe even $48 billion.
So even paying what looked like a high price.
They were actually getting it at a substantial discount to its real worth. At least a 27% margin of safety, maybe much more. They saw the future coupons the market was missing.
And this evolved stage 3 model, it wasn't just for old economy brands like Coke, was it? It could be adapted.
Right. Bill Miller, another well-known value investor, famously applied this kind of thinking to technology stocks in the 90s and 2000s when many traditional value guys wouldn't touch them.
How did he justify that?
He integrated ideas from complexity economics coming out of places like the Santa Fe Institute. These ideas provided a new language for understanding modern business advantages, the modern franchise.
Instead of old industrial models with diminishing returns.
Exactly. Where putting in more money eventually gets you less and less profit back. Knowledge-based industries often show increasing returns. The winners tend to keep winning and winning bigger.
Why is that?
Several key concepts explain it. Things like network effects, where a product gets more valuable the more people use it. Think Facebook or Windows.
Okay.
Positive feedback loops, where success attracts more resources, which leads to more success. And lock-in, where it's just difficult or costly for customers to switch to a competitor. Think about switching your whole smartphone ecosystem.
Right, the hassle factor.
These characteristics create really durable competitive advantages. They help ensure those reliable future cash flows, those future coupons that Williams talked about.
Yeah.
They define the modern franchise.
And Miller saw this with Dell Computer versus Gateway back in the day.
Yeah, great example. Dell was trading at like 35 times earnings. Gateway was much cheaper, maybe 12 times earnings. The superficial Graham investor buys Gateway, right? Cheaper PE.
Makes sense on the surface.
But Miller, the money mind, looked deeper. Dell was generating an insane 200% return on invested capital. Gateway was only doing 40%.
Huge difference.
Massive. Dell was turning every dollar reinvested back into the business into $2 of future value.
Yeah.
Gateway was only turning it into 40 cents. That enormous difference in capital efficiency and future compounding power easily justified Dell's higher PE multiple.
Okay, so this whole intellectual journey, Graham's discipline, Munger's quality focus, Williams's valuation, it all comes together in the ultimate stage 3 investment, Apple.
It really does. When Berkshire made that enormous bet on Apple between 2016 and 2018, making it by far their biggest holding, it showed the complete evolution.
And Buffett didn't see it as just a tech company.
No, explicitly not. He looked past the industry label and assessed the business. He said he views Apple as fundamentally a consumer products company, even a luxury goods company.
The Louis Vuitton of cell phones.
That was his phrase. He pointed out they only sell maybe 13% of the world's smartphones by volume, but they capture something like 85% of the entire industry's profits.
Because of the premium pricing and customer loyalty.
Exactly. The brand affinity is incredible. So Apple has it all from a stage 3 perspective.
Yeah.
The powerful brand value, like Coke, the extremely high returns on capital, like See's Candies could generate, and those modern franchise characteristics, the network effects, and the lock-in from the whole iOS ecosystem.
So he doesn't even think of it as a stock anymore.
He's basically said that. He refers to Apple almost as Berkshire's third major wholly owned business, right alongside their insurance giant, Geico, and the BNSF Railway. It's about owning a piece of that phenomenal economic engine.
So this whole evolution, all these stages, it seems to bring us back to something fundamental Ben Graham said. Buffett calls them the 9 most important words in investing.
That's right. Graham's simple declaration. Investment is most intelligent when it is most businesslike. That is the absolute bedrock principle of the money mind in practice.
Meaning you have to think like you actually own the whole company, not just a fluttering stock certificate.
Precisely. And Buffett has this great mental exercise he suggests to cultivate that mindset.
What?
Imagine the stock market closed down entirely for 5 years, right after you bought your stocks. It's just shut. No quotes, no trading. What information would you then focus on during those 5 years?
Well, not the stock price, obviously.
Right. You'd ignore it because you couldn't see it anyway. You'd focus on the business. You'd read the quarterly reports. You'd watch what management was doing. You'd track the industry, the competitive landscape, the capital allocation decisions.
The actual economics of the enterprise.
Exactly. The core rule that flows from this is purposeful detachment from the stock market's daily gyrations. As Buffett says, eventually, our economic fate will be determined by the economic fate of the businesses we own. Full stop.
And that business owner mindset imposes some pretty strict rules, doesn't it, about what you focus on?
It does. The primary focus has to be on owner earnings. That's the real cash flow the business generates after accounting for all the necessary spending to maintain its competitive position and assets.
Not just earnings per share or EPS.
No. Buffett often calls EPS a smokescreen if it's not backed by real cash generation. It can be manipulated through accounting tricks or by underinvesting in the business. Own earnings gives you a truer picture of the economic reality.
Okay, and this business focus leads to a really clear way to judge management performance, right? The key metric.
Yes, the absolute cardinal mandate for any business, the ultimate measure of value creation. It must generate a return on invested capital, ROIC, that is consistently above its weighted average cost of capital, WACC.
Break that down. ROIC versus WACC.
Okay, think of WACC as the hurdle rate. It's the average cost of all the money the company uses, debt and equity. Let's say it's 8%. That's the cost of keeping the business running.
Got it.
ROIC is the return the company actually earns on all the capital it has invested in its operations. Now, if that ROIC is only, say, 5%, while the cost of capital, WACC, is 8%.
They're losing money on every dollar invested.
Effectively, yes.
Yeah.
Management is destroying shareholder value with every dollar they plow back into that underperforming business.
But if the ROIC is high, say 15%, well above the 8% WACC,
then management has a clear mandate. Reinvest every single penny of profit they can back into that high-returning business to grow it, because it's generating fantastic value.
and if the business is struggling, ROIC below WACC.
Then management's job is not to reinvest. It's to stop pouring good money after bad, and instead return the cash to shareholders through dividends or buying back stock so the shareholders can reinvest it somewhere better.
So the ultimate test of a CEO is?
Their capital allocation skill. Are they maximizing the long-term intrinsic value of the business on a per-share basis? That's the job. Everything else is secondary.
Okay, this intensely rational, business-first approach seems completely at odds with how most of Wall Street operates, especially modern portfolio theory, MPT.
Oh, completely. The money mind fundamentally rejects the core tenets of standard investment management practice, particularly MPT, which really came out of academic work by people like Markowitz and Sharpe back in the 50s and 60s.
What's the main point of conflict? Risk.
That's the big one. MPT defines risk purely as price volatility. How much does the stock price bounce around? They measure it with statistics like variance or beta.
Okay.
Buffett's definition is the polar opposite. For the money mind, risk is the possibility of permanent loss of capital, harm or injury. And where does that come from?
From misunderstanding the business.
Exactly. From misjudging the long-term economics or the quality of management or paying too high a price relative to the actual intrinsic value.
So for MPT, buying a stock during a crash is super risky because volatility, beta, is high.
Right. But for Buffett, that's precisely when risk is often lowest.
How so?
Think about him buying the Washington Post during the brutal 1974 bear market. The stock price was getting hammered, very high volatility, high beta. MPT says danger.
But Buffett saw.
He saw an incredibly dominant newspaper franchise whose intrinsic value was far, far higher than the depressed market price. Because the price was so low, his margin of safety was huge. So he saw it as a low-risk investment, despite the high volatility. For him, high price equals high risk, low price equals low risk, assuming the business quality is sound.
That's a fundamental difference in perspective. What about diversification? MPT loves it.
MPT preaches broad diversification across many assets with low correlation to each other, mainly to dampen down that portfolio price volatility.
And Buffett.
He favors the opposite, focus investing, concentrating your capital in your very best ideas.
Why?
He famously said, "I cannot understand why an investor elects to put money into a business that is his 20th favorite. Why dilute your best ideas with your mediocre ones just to smooth out short-term price swings?"
Is there evidence to back up focus investing?
Actually, yes. Academic research, particularly work on active share by professors like Kremers and Parikh, has shown that investment managers who build concentrated portfolios significantly different from the index, holding fewer names they know well, with low turnover, tend to outperform the broad market averages over the long haul. It validates the idea of betting big on your high-conviction ideas.
Okay, so if the money mind knows what to buy, how to value it, and focuses only on the best ideas, why does the market get it wrong so often? Why is the stock price constantly deviating from that intrinsic value?
Yeah, that's the puzzle, isn't it? And here, it's useful to think about Claude Shannon's work on communication theory.
The father of information theory.
Right. Shannon developed a model of a communication system. You have a source sending a message or a signal. It travels through a channel. But the channel inevitably introduces distortion or noise that garbles the signal before it reaches the receiver.
So the stock market is the channel.
Exactly. The underlying business reality, the intrinsic value, that's the fundamental signal. But the stock market channel is incredibly noisy. The price you see flickering on the screen is the garbled message.
What creates all that noise?
Oh, countless things. Momentum traders buying just because the stock is going up. High-frequency algorithms trading on tiny, fleeting discrepancies. Speculators betting on rumors. People hedging complex derivatives portfolios. Mutual funds doing window dressing near quarter end. Tax loss selling.
So lots of buying and selling for reasons that have nothing to do with the actual value of the company.
Precisely. All these strategies and motivations move prices around constantly, creating volatility noise that has little to do with value proposition, as Buffett would say. Short-term stock prices are mostly static on a line.
So the money mind needs a way to filter out all that static, right? A correction device.
Yes, and Buffett provided one. Focus intensely on look-through earnings.
What are those?
It's basically your share of the underlying company's total earnings, including the portion they don't pay out as dividends, but instead retain and reinvest back into the business to grow it further.
Ah, so it captures the compounding that's happening inside the company.
Exactly. By focusing on the progress of those look-through earnings, the true economic reality of the businesses you own, you can effectively filter out the noise of the daily stock quotes. You see the signal through the static.
Makes analogy.
The beautiful one. If a tree grows in the forest partially owned by us, we still own part of the tree. That retained growth, that increase in underlying value, measured by business reality, not market opinion, that's the only signal that truly matters in the long run. Mr. Market's daily moods are just noise. #tag outro.
Wow, that has been quite a journey, a real deep dive. We've traced how the money mind develops, starting with, the analytical rigor of Ben Graham.
The foundation.
Then enriched by Charlie Munger's insistence on quality and his multidisciplinary wisdom.
The crucial shift.
And finally, arriving at this pragmatic, forward-looking valuation approach needed for modern businesses, rooted in John Burr Williams's ideas. It really is a philosophy built on constant learning, and maybe most importantly, being willing to ditch old ideas when the facts change.
Absolutely. And I think at the end of the day, the reason the money mind is so durable, why it works over decades, isn't just about the intelligence of the formulas. It comes down to temperament.
Temperament.
Yeah. You could almost say the money mind is a virtuous mind in the classical sense. It relies on Plato's cardinal virtues. Think about it. Prudence, that careful foresight needed to estimate those future cash flows. Fortitude, to soothe the courage to stick with your analysis when the market is panicking. Justice, recognizing and rewarding good management, good capital allocation. And temperance, that sound-mindedness, that restraint that keeps you from getting swept up in market manias.
Temperance seems like the perfect word for that long-term, detached business owner approach.
It really is. And that distinction between the method and the temperament is why achieving great investment results is so challenging.
Warren Buffett summed that up perfectly, didn't he? The difficulty versus the ease.
He did. He said, "To achieve satisfactory results is easier than most people realize. To achieve superior results is harder than it looks."
What does that mean exactly?
Well, the easy part, relatively speaking, is learning the mechanics. You can learn Graham's net calculations. You can learn how to build a DCF model like Williams taught. That's the methodology. Anyone can learn that from a book.
Okay.
The hard part, the part that's much harder than it looks, is actually acquiring the patience, the fortitude, the temperance, that purposeful detachment to actually stick with that rational process year after year, decade after decade, while the whole world is chasing noise and reacting emotionally.
So we'll leave you with a final provocative thought drawn right from this architecture of the money mind. Are you, as an investor, spending your time focused on the market's votes, the noisy, fluctuating short-term prices?
Or are you keeping your focus squarely, with that kind of Emersonian quiet confidence, on the business's weights, the underlying compounding long-term economic progress of the actual companies you own?
That choice ultimately defines your entire investment journey.
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button, subscribe for more summaries, and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.